Hello friends, welcome. In this session, I am going to start discussion about how the commercial banks determine the lending rate, right? So, commercial bank have two major functions. One is accepting the deposit and second, providing the loan to its customers. Now, when they are providing the loan, that loan has a cost and that cost is called lending rate. So what is the meaning of lending rate? Lending rate means the rate of interest which is charged by the bank from the borrower, right? The rate of interest which is charged by the bank from the borrower of the money, that rate of interest is called lending rate, right? So in this session we are going to discuss what is the methodology by which banks determine the lending rate, right? So in this session we will discuss a little bit about the benchmark prime lending rate, base rate, MCLR, and finally external benchmark rate system, right? So this session is going to be very conceptual. I recommend that please pick a paper and write down whatever discussion we are making, right? So that will help you clarify the concept in much more depth. So now to start with, let us see how the commercial banks operate, right? And let us see how the commercial banks calculate the lending rate. The basic model, let us see. So suppose this is a commercial bank and let us say, for example, this is State Bank of India. Now this State Bank of India, this accepts deposits from its customers. Let us say rupees 1000 is the amount of deposit made by its customers, and on this deposit it pays some rate of interest, right? So that is called deposit rate. So on this 1000 rupees, for example, let us say the deposit rate is 6% per annum. 6% per annum. So on this 1000 rupees, at the rate of 6% per annum, rupees 60 will be paid by the bank to the depositor. So this is the one thing. Now, bank has received this 1000 rupees. Now, what to do with this 1000 rupees? So out of this 1000 rupees, the first thing that bank will do is that it will take out some of the money out of this and keep that money with the RBI as a CRR, cash reserve ratio, right? So some of the money it will be keeping with the central bank or Reserve Bank of India as the cash reserve ratio. On this cash reserve ratio, the RBI will not give any rate of interest. So let us say, for example, that CRR is 5%. So out of this 1000 rupees, rupees 50 will be kept with the RBI, and on this rupees 50, bank will not be getting any income. So on the one hand, bank is giving 6% rate of interest to the depositor on this 50 rupees, but the bank is not carrying any income on this CRR, right? So now how the bank will recover this amount? How the bank, from where the bank will be giving the interest to the depositor on this 50 rupees. So for that, it will add some percentage into the lending rate, right? To compensate for the loss of interest which is happening because of the CRR, the SBI will increase its lending rate, and that is called the negative carrying cost of the CRR. The negative carrying cost of the CRR. We will see about it, right? So this is one thing, that 50 rupees it will be depositing with the RBI as a CRR. Further, it will keep some amount as the SLR. For example, 20%. So 200 rupees it will be keeping as the SLR, statutory liquidity ratio. This statutory liquidity ratio is kept in the form of cash or gold or government security. Right. Now remaining 750 rupees, it is free to give to the borrower as the loan. Right. So remaining 750 rupees can be given as the loan. Now what is the rate of interest which the SBI will be charging on this 750 rupees? So it is very common sense that this 60 rupees which is being paid to the depositor, first of all this 60 rupees will be charged, and this 60 rupees is also called as, this 60 rupees or deposit rate is also called as the cost of fund. The cost of fund. Why this is called cost of fund? Because this deposit is providing funding to the bank, and on this funding the bank is paying this amount of rupees 60. So this 60 rupees is the cost of fund, or this 6% per annum is the cost of fund. So the first component of the lending rate. So let us see the lending rate calculation. The first component of the lending rate will be the cost of fund, or in other words deposit rate. The cost of fund or deposit rate. This is the first component, right? Second, as I discussed, that bank is not earning any money on the CRR. So it is very natural that the SBI will add this negative carry cost of CRR in this lending rate, right? So this is the second item. Now third item, the next item. So can you think what can be the next item? So next item is the administrative cost. So bank is carrying out lot of operations. It is giving salary to its employees. It is giving the rent for the premises and many other operational cost. So this administrative or operational cost is also added. And at the last, this bank is commercial. That means the main motive of the bank is profit making. So some amount of profit margin will also be added in this amount. So can you see there are four major components. First is the cost of fund or the deposit cost. Second is the negative carrying cost of the CRR. Third is the operational cost, and fourth is the profit margin. So this is how the lending rate is determined. This is how the lending rate is determined, right? So this is how the lending rate is determined. I hope you are able to understand how the lending rate is determined. If you are able to understand this thing, then you can easily understand MCLR, external benchmark rate, base rate, etc. So all those terms you can easily understand. Now next thing, let us discuss the impact of repo rate change on the lending rate. So we usually hear that RBI decrease the repo rate and consequently the commercial bank decrease the lending rate, or vice versa. That means RBI increase the repo rate and the banks also increase the lending rate. So repo rate and lending rate, both of them are having some linkage. So suppose this is the Reserve Bank of India, and Reserve Bank of India is giving the loan to the commercial bank at the repo rate. So repo rate or policy rate is the rate at which the RBI provides short-term lending to the commercial banks, right? So RBI is providing the short-term lending at the repo rate to the State Bank of India, for example. Now, suppose the repo rate, this is increased. There is increase in the repo rate. What is the impact of increase in the repo rate? The first impact is that there is corresponding increase in the reverse repo rate. What is the meaning of reverse repo rate? Reverse repo rate is the rate of interest which is offered by the RBI for the loan which RBI takes from the bank. So bank deposit the money with the RBI, or RBI takes the loan from the commercial banks, and the rate of interest which is provided by the RBI to the bank, that is called reverse repo rate. And you must be remembering that this reverse repo rate is to the extent of this is less than the repo rate to the extent of minus 0.25%, right? So this 0.25% is the policy corridor rate. This is the policy corridor rate. So as of now, this reverse repo rate is 0.25% less than the repo rate, right? So increase in the repo rate means there is increase in the reverse repo rate. That means the bank can deposit with the money with the RBI and get extra income, right? So bank's income is able to increase. Bank can increase its income. This is the one aspect, right? So the bank earn more income. This is the one aspect of change in the repo rate, right? Another aspect is that this increase in the repo rate also increases the interest rate in the capital market. Interest rate in the capital market, that is interest rate of the bond, right? Interest rate of the bond. Now, if we see from the customer perspective, so now let us see from the customer perspective. Now customer is having two options. Either it can deposit the money or deposit its savings with the SBI, or it can go into the bond market and buy the bond. Now since the bond interest rate are increased, therefore there is a possibility that bank's customer will withdraw the money and buy the bond, right? Because the bond are carrying high rate of interest. So to avoid this kind of transaction, to avoid the tendency where the customer will buy the bond and withdraw the money from the saving account, to avoid that tendency, bank will increase the deposit rate, right? So another impact of this increase in the repo rate will be that bank will have to increase its deposit rates. Bank will have to increase its deposit rate, isn't it? So bank will have to increase its deposit rate. If the deposit rate is increased, then definitely the cost of funds element in the lending rate, this is automatically increased. The cost of fund element in the bank rate is automatically increased. There is no doubt about it, right? So there is no doubt that this cost of fund element in the lending rate will also increase. So can you see this increase in the repo rate is resulting into increase in the cost of funding. Similarly, if there is decrease in the repo rate, there will be decrease in the cost of funding. So this is the link that I wanted to show you. So change in the repo rate has a direct impact upon the change in the cost of fund, and all this we have seen over here. Now, next thing, let us see the historical overview of the different type of lending rate, and these different type of lending rate are also called as anchor rates. So they are also called as the anchor rates because they act as the anchor. Now, starting from the independence time. So before the independence, in India, we had majority of the banks in the private sector. Being in the private sector, it was their choice that how they want to determine the cost of lending. So till the independence, the private sector was the dominant force, and they will automatically determine their cost of lending. In 1947 and during the time of nationalization, this administered interest rate became the norm. In this administered interest rate, it is the government and the RBI who will determine the interest rate. Then we started facing many problems just before the 1991. We faced the BOP crisis, and at that time we realized that there is over centralization of the power with the government, and banks should be regulated. So banks should be deregulated. So at that point of time, this flexible interest rate regime was started on the recommendation of the Narasimhan Committee. So on the recommendation of the Narasimhan Committee, this flexible interest rate regime was started. Right? Now, in 2006, this benchmark prime lending rate was introduced. Benchmark means a reference point. Sorry for the inconvenience. So benchmark means a reference point. Prime lending rate means the lending rate to the prime borrower. Who is the prime borrower? Prime borrower is a credit worthy customer. The customer who is having very good image, is very successful, has a high chance of returning back the money. So that customer is called prime borrower, right? So the rate of interest which is offered to this borrower, that is called prime lending rate. So benchmark prime lending rate was, the concept of benchmark prime lending rate was introduced, right? Now this was the rate which was offered to the prime customers. The problem arose that this BPLR, this was set at a very low rate. So it was up to the bank to determine this BPLR. They will determine their own BPLR. So banks will keep this BPLR very, very low, and they will offer the very low rate of interest, maybe 2%, 3%, to the big industries, to the high net worth individuals, because big industries, high net worth individuals, they were the people who were having very good and prime credit worthiness. They were the prime borrowers. So the industrialists, corporates, high net worth individuals, rich people, they will get the loan at a very low interest cost, right? So they used to get loan at a very low interest cost. Now, when they are getting the loan at a very low interest cost, definitely at some point of time, the burden will increase on other people, the other customer. So the other customer, like farmers, middlemen, and the other people, their loan rate was increased. So the cost of lending were increased for the other people. So this BPLR has started having the adverse impact on the non-credit worthy customer. So it created the inequality. It started having the negative impact. It started having the adverse impact on the other customer. Therefore, in 2010, the concept of base rate was introduced. The concept of base rate was introduced. This base rate is actually linking the lending rate with the cost of funds, right? So in case of BPLR, there was no linking with the cost of fund, but in case of base rate, the lending rate was linked with the cost of fund. So this base rate means the minimum rate of interest or minimum rate of lending which can be offered to any customer. So any bank cannot offer any loan below the base rate. So whether the customer is corporate or any other person, there will be some minimum rate, and that rate will be based upon the cost of fund. So this will avoid the problem which arose because of the BPLR, right? Now in this base rate, the problem started that this cost of fund also had the cost of fund of the past, right? So when new loans are given, those new loans must have been sourced from the new deposit, right? So when bank is giving new loan, that means the money will be coming from the new depositors. So the new loan should be the cost of new loan, the lending rate of the new loan, that should be based upon the cost of fund of the new deposit, the latest deposit, right? Then only there will be a fair linkage between the lending and the borrowing. Otherwise, it is possible that because of the base rate, because of the total cost of fund, the past high cost of fund may impact the current borrowers. Like, I will discuss this concept again when I discuss the concept of base rate in the MCLR in the next slide. So don't worry. So I will discuss this concept with an example. Don't worry, I will discuss, right? This base rate is based upon the average cost of fund. This is based upon the average cost of fund. In this base rate, the problem arose that this average cost of fund started impacting the new borrowers. So to avoid the problem of average cost of fund, what is the problem of average cost of fund? I will discuss in the next slide with an example, right? So to avoid this, we started with the concept of marginal cost of lending based rate, MCLR. So here the word marginal means additional cost of lending rate, right? So here this MCLR is based upon the additional cost of funds. Again, I will discuss this additional cost of fund and the average cost of fund separately, right? EBR, external benchmark rate. So in this MCLR also, the problem arose that this was not based upon the repo rate. This MCLR was not based upon the repo rate. So when RBI changes the repo rate, it does not impact the lending rate. When RBI changes the repo rate, it does not impact the lending rate. So to avoid this problem, this external benchmark rate was introduced. So this, in the external benchmark rate, this is linked with the policy rate. This is linked with the policy rate. So don't worry friends, I know that this base rate, MCLR and external benchmark rate, you have not understood completely. I will discuss all of them in a very detailed manner, right? So here we will discuss about base rate, MCLR and EBR in detail. Don't worry. This is the main concept that I wanted to discuss. Before that, everything that we discussed so far, that was the background and the foundation. So now this is the main thing. Now, first of all, what is the status as of now? As of now, base rate is no longer applicable. It was abandoned in the 2016. So in April 2016, this base rate was abandoned. MCLR, marginal cost of lending rate. This is in effect from 1st of April 2016. And external benchmark rate. External benchmark rate is in place for selected categories of loan since October 1, 2019. So since October 1, 2019, for selected loan categories, the external benchmark rate based lending rate is there. So this is the date of applicability. Now, who decides the base rate? Base rate is decided by the bank itself. The calculation of base rate is done by the bank itself, but the method is given by the RBI. So who gives the method? RBI gives the method. Therefore, this is called internal benchmark. Internal benchmark because the bank itself is deciding. Therefore, internal decision is happening. So this reference rate is internal only. Therefore, this base rate is also called as the internal benchmark rate. This MCLR also, this is determined by the bank itself, but as per the RBI methodology. Therefore, this is also called as the internal benchmark rate. However, in case of external benchmark rate, the name itself suggests that benchmark is external. The bank do not decide. So who decides? Some external authority, for example RBI. So the bank do not decide. It is the external benchmark. These two are the internal benchmark. This is the external benchmark. Now, what are the components? What are the components? The components of base rate. The first is average cost of fund. So what is the meaning of average cost of fund? Let us discuss. For example, in year 1, the bank received 1000 rupees at 10%. In year 2, the bank received as deposit 1000 rupees at 9%. In year 3, 1000 rupees at 8%. Right? So, in case of base rate, when we take the cost of fund, this cost of fund will be based upon these three rate, the average of these three rate. So the average rate is 9%. So in this case, the average cost of fund will be taken as the 9%. Second is negative carrying cost of CRR. I already told you that this is the cost we are including here because the bank do not get any income from the RBI on the amount of CRR. Operating cost means the administrative cost, rent, salary, etc., which are incurred by the bank. Profit margin, because bank is the commercial entity, therefore it is very natural that they will add their own profit. So these are the four components of the base rate. And what is the periodicity of this base rate? The periodicity of this base rate is based upon the bank's discretion. The bank will change this base rate at any point of time as per their own discretion. There is no periodicity, right? This is about the base rate. Now coming to the MCLR, marginal cost of lending rate. First component is marginal cost of funds. What is the meaning of marginal? The word marginal means additional. The word marginal means additional. So marginal cost of fund means additional cost of fund, the latest cost of fund. So coming back to this example, in this example, year 1 cost is 10%, year 2 cost is 9%, year 3 cost is 8%. So the latest deposit rate which is offered by the bank is 8%. So when people are depositing their money, they are getting 8% from the bank. So it is very natural that the people will expect the borrowing rate somewhere close to this latest deposit rate only, right? So this latest deposit rate or the latest additional cost of fund, this is taken here in the marginal cost of fund. In other words, let me give you another perspective, another point of view. So in case of base rate, the total funds which are available with the bank, and their cost, that is averaged, right? So the average cost of fund, total cost, whether the cost is of today's fund or the fund belongs to 10 years ago, 20 years ago, when the rate of deposit were very high, right? So all the funds are included, all the cost is included. In case of MCLR, only the additional funds which have been raised by the bank for giving the additional loans, I am repeating, the additional loan which has been raised, additional deposit which have been raised by the bank for giving the additional loan, only that cost is considered. So this is the additional cost of fund. So in this case, this 8%, in this case, this 8% will be taken as the additional cost of, this 8% will be taken as the additional cost of fund. This 8% will be taken as the additional cost of fund. So here the average cost of fund is 9%, here additional cost of fund is 8%. So it reflects that MCLR is much more closer to the latest deposit rate. It is much more closer to the current market situation. So therefore, this marginal cost of lending, this reflects and transmits the impact of repo rate in much more better way. The base rate do not reflect or do not transmit the impact of repo rate, because in this case the average cost of funding is there. These three different years cost is taken, but in case of marginal cost of lending, the latest deposit rate are there, and latest deposit rate are based upon what? The latest deposit rate are based upon the repo rate. The latest deposit rate are based upon the repo rate. So very naturally we can say that the change in the repo rate will be reflected through the marginal cost of funding. So when there is a change in the repo rate, it is quite natural that this MCLR will also change. So this will also increase the transparency. This will also increase the transparency, because the customer can expect that when the RBI is changing the repo rate, there will be some change in the MCLR also. So first is increase in the monetary transmission, and second is the increase in the transparency. Other two components are same, negative carrying cost of CRR and operating cost. Last component is tenor premium. What is the meaning of tenor premium? Tenor means for the long duration loan. It stands for long duration loan. Premium means the extra cost of because of extra risk, right? So when the loan is for long duration, then the bank has more risk of not coming back of the loan. So there are more chances that bank will not receive back the loan. So there is more risk. So for the long duration loans, this tenor premium is added in the lending rate. So the long duration loans are having high rate of interest because they have the high risk. So to increase the rate of interest, rate of the lending rate, this tenor premium is added in case of the long term duration loans. This MCLR, it is changed every month. So whatever changes are there in the latest cost of fund, they will be reflected in the MCLR. So every month this MCLR has to be changed. Now coming to the external benchmark rate. This external benchmark rate, this says that there are four options which can be taken as the reference rate. So in this case we are not taking the average cost of fund or marginal cost of fund. Rather, in place of average cost of fund and marginal cost of fund, we are taking the four different options. So the bank have four different options. Either they can take policy rate or repo rate as a reference rate. So this is the first option, that they can take the policy rate as the first option. Like they can base their lending rate on the repo rate or the policy rate. Another is 91 days treasury bill yield. What is the meaning of treasury bill? Treasury bill is a government security, right? So in case of treasury bill, face value is there and the issue price is less. For example, the face value is 100 rupees and issue price is 90 rupees. So the buyer of the bond, buyer of the treasury bill, he will pay 90 rupees, and at the end of the maturity period of the treasury bill, he will receive back 100 rupees. So overall he will get the 10 rupees as the income. So this is how the treasury bill work. So 91 days, the duration of the treasury bill is 91 days. The maturity period is 91 days. Yield means the income which is earned by the holder of the treasury bill. So this yield, this rate of yield is taken as the reference rate. Another is 182 days. So the treasury bill whose maturity period is 182 days. And fourth, any other rate given by the Financial Benchmark India Private Limited. So this is an entity which is a company, and this company can give some other rate also. So that rate can also be taken as the reference rate. So these four options: policy rate 91 days, treasury bill yield 182 days, treasury bill yield, any other rate by the Financial Benchmark India Private Limited, they can be taken as the reference rate. And upon these reference rate, there will be some spread. Spread means some addition by the bank itself. So this addition will be there for the operating cost and for the profit. It is very natural, right? For the operating cost and for the profit, there will be some spread. For example, this repo rate is 5.15%. So in this 5.15%, 2% spread will be added by the bank itself as the operational cost and as the profit, right? So this 2% is decided by the bank itself. So this spread is also added in determination of the external benchmark rate. Now, what is the periodicity of the external benchmark rate? External benchmark rate is calculated every 3 months. So every 3 months external benchmark rate is calculated. Now, what is the speciality of the external benchmark rate as compared to the marginal cost of funding based lending rate? So in case of marginal cost of funding, this is again based upon the cost of funding. This is again based upon the cost of funding. The cost of funding may or may not be based upon the repo rate. So if I say that this marginal cost of fund actually reflects the repo rate, then this is partially true. This is partially true. So to make the monetary transmission 100%, to ensure that change in the repo rate is 100% transmitted to the customer, to the household, to the borrower, this external benchmark rate based lending rate, it offers these rates. So it will ensure that when there is a change in the repo rate, it automatically transmits to the local household, borrower, customer and the people, right? So this monetary transmission problem that we are facing, what is the issue of what is the problem of monetary transmission? The problem is that RBI is changing the repo rate, but there is no consequential impact upon the lending rate. So this problem can be eliminated if external benchmark lending rate is followed, and RBI can control the money supply in a more effective manner. If RBI is able to control the money supply in a more effective manner, that means the problem of inflation can be controlled. That means the economic growth can be ensured. So the monetary policy objective of inflation control, ensuring the sustainable economic growth rate, both objectives can be sustained. So that is the larger overall impact of adopting the external benchmark rate. Now let us see the comparison between the MCLR and external benchmark rate. So because base rate has already been eliminated in 2016, so we are not supposed to discuss that rate too much. But this MCLR, it is applicable so for some category of loans right now also, and this external benchmark rate, this is applicable for some loans as of now. So if we see the applicability, this point is not mentioned over here. So you just note down in your notes. This MCLR is applicable for all loan categories. So whether the loan category is fixed interest loan category or floating interest rate loan category. What is the fixed interest rate loan category? The fixed interest rate category means the rate of lending is fixed. For example, 10%. So 10% is fixed. Whatever is the repo rate, whatever is the cost of funding, the bank will always charge 10% as a lending rate from its borrowers. That is fixed rate of interest. Another is floating rate of interest. In case of floating, the bank is changing the rate of lending from time to time and customer agrees to that, right? So floating rate, it keeps changing, right? So MCLR is applicable for both fixed and floating rate of interest. In case of external benchmark, this external benchmark rate is applicable for selected categories of retail and personal loans which are based upon the floating rate of interest. Retail and personal loans which are based upon the floating rate of interest. And another is the loan which are given to the MSME and which are floating also. So the floating rate of interest given to retail, personal and the MSME categories, they are now mandatory to adopt external benchmark rate. So now let us discuss benefits. So benefit of MCLR as compared to BS rate is that it increases the monetary transmission and it also improves the transparency. Then it ensures the fairness in the lending rate. How does it ensure the fairness in the lending rate? Because it ensures that the latest cost of fund are used to determine the cost of borrowing. If the latest cost of fund is less, then the new customer should get the less rate of interest. So this ensures the fairness in the lending rate. It also increases the competitiveness of the bank, because now the bank have to compete with the mutual funds, the saving schemes of the government, the bonds. They have to compete with the NBFC also. So they have to really be there and understand the current market situation. This MCLR tries to be very close to the current market rate of interest. So this ensures the increase in the competitiveness of the bank. What are the issues? The issues are banks are not able to decrease the deposit rate of interest, because again there is a lot of competition the banks are facing. So to maintain themselves in the race, they cannot increase the deposit rate. Now because they cannot deposit the deposit rate, therefore their cost of funding will also not be reduced. So banks' inability to reduce the deposit rate forces MCLR to be ineffective. Then government is offering high interest on the savings. I already told you the banks are facing a lot of competition from the other securities. What are the benefits of the EBR, external benchmark based lending rate? First, it maximizes the transmission, it maximizes the transparency. So when repo rate or any other policy rate is directly linked to the lending rate, then customer can see the direct impact upon the change in the policy rate. So there is a transmission and transparency both. But there is a problem. The first problem is that the bank don't have the complete access to the repo based fund. So even though they have to change their lending rate as per the repo rate, but their cost of funding will not be reduced. When their cost of funding will not be reduced, their profit will be adversely impacted, right? So if the repo rate is decreased, but their cost of fund is not decreased, then they will have the problem, because due to decrease in the repo rate, they are forced to give the loan at the less rate of interest, but their average cost of fund is not decreasing. So overall their profits can be adversely impacted. Second, treasury bill yield, which has been taken as the reference rate, one of the policy rate, right? So this treasury bill yield, it is very volatile. It is based upon the fiscal situation. If the fiscal deficit is increasing or decreasing, that adversely or positively impacts the treasury bill yield. So this treasury bill yield is not the independent rate. This actually depends upon the government activities, government decisions. And more than 85% funds come from the saving account, and this saving account is not directly linked to the repo rate. So the profit, as I discussed in the first point, the profit will be adversely impacted as far as the banks are concerned. I hope you are able to understand the concept of base rate, MCLR and the external benchmark rate. These three concepts people normally confuse, right? I hope that you can solve any questions which will be coming from this area. So far one question appeared from MCLR. I will discuss that question separately. Thank you very much for watching this session, and I hope that you have made your own handwritten notes. They will help you in revising this topic because this topic is a little bit more complex. If you have any problem, please WhatsApp or email me. I will solve your questions. Thank you very much. God bless you.